Welcome to Dallas Dirt. I am your host, Candy Evans, and today we have a very special guest, a lady who I've known for a long time and is totally respected in Dallas. It's Lisa Peters with Cardinal Financial.
Hi, good morning.
Thank you so much. Now, Lisa knows mortgages because, as we all know, we buy homes. We don't just buy it. We've got to go get a mortgage to finance that.
Right.
And that is really, to me, one of the biggest parts of the American dream in the United States is that so few of us can afford to dish out $500,000 for a home, but we can get financing for it. And you point out so wisely that, houses are not going down in value. They continue to appreciate.
Right.
So,
and I think a lot of people look at the news and, some areas may be simmering or maybe even dropping in value some, but not in our area, not in the Dallas-Fort Worth Metroplex.
No.
We're still seeing, and I'm very conservative when I say a 3% drop or a 3% appreciation level in properties. That's conservative. It's really more like 7% this year.
Right. It's from last fiscal year to this
from last year over
exactly.
year over year. So I don't want people to think I'm overselling them when I'm talking to them about this. So I use the 3% as an example in any of my analysis. That's what I'm going to use.
Right.
But the reality is we have more people moving in
right.
than we have houses for them.
That's demand.
And that's demand.
Right.
And so the uptick, I've seen an uptick in business lately because I think people are adjusting to where we are. They have come to the table to where we are. Mm-hmm. And that is in accepting where the interest rates are, because had they done it last year, they wouldn't be paying mid-sevens or, mid-sevens or anywhere in the sevens.
You snooze, you lose.
They would have been in the sixes. And they would not have paid as much for that same house they wanted last year than they are this year.
So they're getting that.
So people are getting it. They've waited it out. It's not happening.
Wow. But no, so tell me, do you really think that folks ought to just go ahead, get their mortgage, kind of bite the bullet, do what they want to do now?
The math is going to work in their favor.
Okay.
Because if next year the house that they want is going to be 3% more and 3% more. So if the spread in interest rates from what's tolerable, I used 5.5% is people's target. That's where I want to be. 5.5%. Well, I'll just use 7.5. It's a little under 7.5 now, but let's just use 7.5. So you've got a 2% spread in interest rates. If you've got a 3% spread in the housing, you're still going to come out ahead. And that's on a very conservative level.
Right.
Very conservative.
Because you're figuring the 3%.
Yeah.
Right.
And the lower the interest rates go, I think the more appreciation we're going to see just because of multiple bids.
Right. Because you'll have more people out there.
Right.
More buyers. So what happens with, are you seeing programs, I'm sure you offer them, where that you're going in at the 7.5%, which is what it is now, but that in 3 years you can refinance?
Yes, absolutely.
Are they?
All the lenders are saying there's not going to be any lender fees. There's no lender fees cost. We can't waive third-party costs because we don't control their checkbook. But we can say there's not going to be any lender costs. But one program that's pretty popular right now, especially with first-time buyers or anybody who wants their interest rates lower in the beginning, they're buy-downs. There's a 3-2-1 buy-down, which means if your interest rate today is 7.5%, on a 3-2-1 buy-down, the first year is 3% below. So it starts out at 4.5%. So how you calculate the payment is, what's the difference? 4.5 to 7.5. So that difference times 12 months, put that aside. That's one bucket. Next year, year 2, it's 2% below. So it's 5.5%. What's the difference in that payment? That goes in that bucket. And then year 3, it's 1% below. And year 4 through 30, it's at the regular rate. So all of these buckets add together, and that's the cost. That's the cost of the buy down.
The buy down.
And generally, a seller is going to pay that for a buyer,
so they can get the home sold.
And there's also just the 2-1 buy down, meaning it's just 2% below 7.5. Then years, the second year it's 6.5. So, and then 7.5 years 3 through 30. So that cost obviously less than a 3-2-1 buy down. But at any time, this is what is maybe not conveyed out there. At any time that interest rates would fall to a point where a buyer said, I'm just going to refinance now, any funds not used in those buckets can be applied towards their refinance.
Oh.
Those funds are theirs. They are put in an escrow account set aside for them.
Does it earn interest?
No. It's like escrow account, they don't earn interest. But still, this is a good plan.
It's a good plan
for someone who wants to get in now. They want to buy their interest rate down, and at any time,
it's 3% below the going rate.
It can start out 3% below or 2% below.
That's significant.
And everyone thinks in the next couple of years, interest rates are going to go down. So that 2-1 buy down, you could use any leftover funds to buy that interest rate down, or that 3-2-1 buy down.
Right.
Those funds are the borrowers.
Yes. And
they're not going to give those up.
And they belong to they go with the house, so they go with the loan, correct?
They go with the loan. Yes. So if the loan's refinanced, that will apply towards that refinance, either their cost or their balance.
Well, that's really cool.
So that's really a huge benefit, and a way for first-time buyers especially to get in this market.
Well, I've been wondering for a long time, because we bought early on our very first home. The interest rates were 14-16%, and it was atrocious. And we actually, we leased for another year until they really didn't come down. We just got in, just like you. We just got in.
Just said okay,
and we just wanted
King's X.
Exactly. But we bought a home once, and the owner financed a second for us, a second mortgage.
Yeah.
And I remember we paid him off in full, and of course we sold that home, and he was paid off. Have we seen any owner finance?
I have not seen any owner financing.
There's ways,
but it's still there.
It's there, and there's ways around this.
It's still there.
Yeah.
So, but what's not known is that Fannie Mae, Freddie Mac, if you have a combination loan, regardless of who's carrying that second, there's still what's called loan level price adjustments. So Fannie and Freddie still charge up if they're at 80% and there's a second lien behind it.
For 20%, say.
Yeah, or 15.
Right.
You can't get 100% financing anymore. Not right. Not yet.
Not yet.
So, not right now. But if it's a 95% combined loan to value, 80% is the first lien lender.
Yes.
The second lien is 15, 10, or even 5%. Then, regardless of who's carrying that, Fannie Mae charges up for that. Fannie and Freddie.
Oh,
they consider it higher risk than if they have private mortgage insurance behind them.
So would they do that in the terms of the interest rate, or would they just so it's a higher interest rate?
It's how you price money. It's
like
how you come to. It's how you come to an interest rate. So a buyer that might have 740 and above credit scores, they would get a different rate generally than someone with a 680, because there's price adjustments to that 680 that don't exist on that 740. Risk levels. It's all about risk.
Exactly.
Yeah.
And that's what even though they have the home, as these mortgage companies they can always sell the home.
Right. Yeah. Well, they don't want the home.
They don't want it though, because
they don't want
the
real
home estate business.
And
we learned that a few years ago.
Right. Correct. Right.
Right.
They don't want the house. They don't want to have to foreclose.
Right.
And I've had people tell me, well, wow, Wouldn't you be delighted to get that one back? Well, not really.
Not really.
Not
Yeah.
really.
Yeah.
That's not what we're in business to do.
For. And that's why there were so many stories of the squatters and all this stuff, because these homes just sat vacant and empty for the longest time.
Yeah.
Yes. So let's talk about, what you can do to get the very best mortgage. Because obviously now with the mortgage rates at 7.5%, you want to make sure you're not doing anything to, negatively affect your ability to get that. Right.
Well,
So,
it's all about debt to income ratios.
okay.
It's credit score, 740 and above.
Right.
We'll get the best rate offered in the market. And
800 is perfect, right? Is 800 perfect?
Well, anything over 740
Is
priced the same.
priced the same.
So
Okay.
whether if you're 800,
Okay.
you're a member of an elite club. If you're all three are 800 and above, I say you're a member of the 800 club. Congratulations, that's awesome. It didn't get you anything, but awesome.
But awesome.
But awesome. I mean, you just have to pay your bills on time.
Yeah.
And, keep your debt to income ratio lower. And a 25% down is going to get you a little better price than a 20% down.
Oh, what about 50%?
It's yes, 50%. Loan to value, the lower the loan to value, the better the terms you're going to get. Yeah.
So that's
all about
secret.
risk. It's all about risk. And risk, when I talk about risk, Fannie, Freddie, that's who I'm talking about. They decide what the risk levels are, and lenders don't decide.
Yeah, it's all, and you can't change that. It's like
it's not negotiable.
Exactly. A lot of, I think, young buyers that I speak with are like, well, why aren't they? This is like the real world. I mean, it's kind of, this is what happens with the way you handle your finances. It's very important.
It is very important, and I really feel sorry for people that something has popped up on their credit report that they don't know about.
Oh yeah.
And maybe it's wrong, maybe it's in error. It takes a long time to get that off.
Oh yeah, the bureaucracy of it.
Yes, and it really shouldn't be that way. So the best advice I have for anybody, there are some paid apps that give you real time. My FICO is one of them. It's you pay a monthly fee for that. But Credit Karma is a free service. I think credit cards give you, but Credit Karma goes in with all three bureaus, and it tells you if you had a pull on your credit report, what your current balances are. It gives you a snapshot of where you're at. So it could warn you in advance, or at least warn you if something's going on with your credit.
So to kind of recap this, if you're looking for a mortgage today, it's not impossible. There's programs out there.
Absolutely.
There's buy downs, but do make sure that you sort of clean your house up financially before you apply, because you want to get that very best shot by having that the higher FICO score.
Right.
Yes. With lower debt, higher FICO score.
One thing we've not talked about is the down payment assistance program and it's not just for first time buyers.
Okay.
You can own a house and get down payment assistance for another primary. That's not for investment properties. It's not for second homes. But this gives you anywhere from 1% to 5%.
Wow.
Of your loan amount. So if you're doing a minimum down payment, 3% down. If you're a first-time buyer, 3% down. If you're a second-time buyer, 5% down.
Wow.
But it will give you anywhere up to 5% of your loan amount.
And how is this? What is this through? The government?
State.
The state? Texas?
State. Yes. And there's 3 or 4 different programs on that.
Oh my God.
But
she knows everything. I mean,
but that gives you the ability to get in. Now, those programs, generally, there are grants that you don't have to pay back. They have a lot of qualifying criteria.
Yeah.
And then there is the plain down payment assistance. These have a 3-year hard payback, prepayment. So after 36 months, you don't have to pay a cent back. So you have to live in that house for 3 years.
That is so wonderful. That really encourages home ownership.
It's an amazing program.
We need to
Truly
write, we
is.
need to write about this. I
Okay.
think we should. I really
Yeah.
didn't realize there were so many programs out there.
There are
Yeah, and I'm
that will give down payment. Now,
Yeah.
interest rates are higher
yeah,
on those,
Yeah.
but they're giving you something.
they're getting you.
I call it money falling from the sky.
It really is, and that doesn't happen a lot.
Right. And there is a price for that, but if
On
you
the
can
prices
get,
you stay in your home.
if you can get in
Mhm.
to a market where you would not be able to get in, it's a
Yeah.
great tool.
It's a great.
It's a great tool, and you get to start that appreciation
Yes.
year
There.
after year. 3 years, you'll probably have enough. If you want to sell, after 3 years, if this is your starter home, it's not your forever home,
Right.
then after 3 years, you should have enough equity in that home. You're not paying back that initial money,
Right.
and you should have enough equity to take that and start building your wealth. That's what I call it, real
Build your
estate
wealth.
wealth.
And that's what real estate does, and that's what homes do.
It does.
Lisa, we are totally going to follow up with a story on this because I'm just so impressed with it, and I'm so happy that you know about. This is why you have a mortgage broker like Lisa, because she will find the program. She knows the ins and the outs, and she knows how to get the job done.
Yeah.
I know personally.
Right.
So this is great. We'll follow up with that. We'll have you back. I think that it's probably a good idea for us to talk about mortgages a couple times a year.
Yeah.
And to talk about the market and get people set
I
straight.
think so. But I mean, there's always programs that come out. I mean, like for jumbo loans.
Right.
There are jumbo loans that you can put as little as 10% down.
Wow. That's great.
Yeah.
So people, it's possible. Don't let the mortgage interest rates get you down.
Right.
You can do it.
Right.
And we'll help you.
Right.
Lisa will help
Start
you.
building your wealth.
Exactly. Yes. Especially the young people. I always tell them, get in that house as soon as you can.
Right. Yes.
Thank
I
you
agree.
for being with us today.
It's been so much fun.
I know.
Yeah.
It's fun. We love talking.
And I love talking with you all the time because, we could do this for hours and hours.
We love this stuff, and you will always have more real estate information, good, valuable information here on Dallas Dirt. Thank you so much for joining us. I'm Candy Evans.
That does it for this episode of Dallas Dirt. Join us the next time as we dig into DFW's hottest real estate news with host Candy Evans. Be sure to subscribe on Apple Podcasts, Spotify, or YouTube to receive every new episode. And if you like the episode, give it 5 stars and tell a friend. Thank you for listening, and we look forward to seeing you the next time. This episode was recorded at the Real News Communications Network studios in Dallas and is copyrighted by Dallas Dirt.